You know what's frustrating? You finally took the leap, formed your LLC, and your business is actually making money. But now you're staring at your business bank account wondering, how the heck do I actually pay myself? And more importantly, how do I do it without the IRS coming after me or losing half my profits to taxes? I'm Tiffany Phillips, CPA and tax strategist, and I help business owners legally reduce their biggest expense, taxes, so they can keep more of what they earn and build real wealth. If you've ever felt confused about whether to cut yourself a paycheck, cut yourself a check, or just transfer money to your personal account, you're not alone. I get this question literally every single week from business owners who are making great money but have no clue how to get it out of their own pockets legally and tax efficiently. Here's what's crazy. Most CPAs will give you the basic answer, just take an owner's draw, but they won't tell you the strategic part. They won't tell you about the timing, the tax implications, or when you should actually consider switching to an S Corp election to save thousands. Today, I'm going to walk you through exactly how to pay yourself from your LLC, how much to save for taxes, and the critical mistake that could cost you over $10,000 a year if you're making decent money. Plus, I'll share the exact threshold where you need to stop being an LLC and make a change that could literally save you five figures annually. Let's start with the fundamentals because I see way too many business owners overthinking this. If you have a single member LLC that hasn't made any special tax elections, paying yourself is actually pretty simple. You take what's called an owner's draw or owner's distribution. Here's what that means in plain English. You transfer money from your business bank account to your personal bank account. That's it. You can write yourself a check, do a bank transfer, use Zelle, whatever. The method doesn't matter as much as understanding what's happening from a tax perspective. Here's where it gets interesting and where most people get confused. You're going to pay taxes on all of your LLC's profit, regardless of how much you actually take out. Let me say that again because this one trips everyone up. If your LLC makes $100,000 in profit and you only pay yourself $50,000, you're still paying taxes on the full $100,000. This is because LLCs are what we call pass-through entities. All the profit passes through to your personal tax return, whether you take it out or leave it sitting in the business account. The IRS doesn't care where the money is. They want their cut of the profit. I had a client last year who made this exact mistake. She left $80,000 in her business account thinking she'd save on taxes, then got hit with a massive tax bill in April. She called me panicking because she owed more in taxes than she had in her personal savings. Don't be that person. The key here is understanding that as an LLC owner, you're not an employee of your business. You don't get a W-2, you don't have taxes withheld from your paycheck, and you definitely don't 1099 yourself. That's actually incorrect and could cause problems. Now let's talk about the elephant in the room, self-employment tax. This is the 15.3% tax that hits LLC owners on top of their regular income taxes, and it's brutal if you don't plan for it. Here's how it breaks down. 12.4% goes to Social Security and 2.9% goes to Medicare. When you're a W-2 employee, you pay half of this and your employer pays the other half. But as an LLC owner, you get to pay both sides. Lucky you, right? So if your LLC makes $100,000 in profit, you're looking at $15,300 in self-employment tax alone before you even touch federal and state income taxes. In a high tax state like California or New York, you could easily be looking at total tax of 45 to 50%. This is why I tell my clients to save 30 to 40% of their business income for taxes. I know that sounds like a lot, but trust me, it's better to overestimate and get a refund than to underestimate and owe penalties. Here's a strategy most people don't know about. You can set up a separate business account to make this easier. Have your main operating account where income comes in and expenses go out. Then set up a tax savings account and automatically transfer 35% of your profit there every month. Treat that money like it's already gone to the IRS. But here's where it gets really interesting, and this is the part most CPAs won't proactively tell you about. Once your LLC is consistently making over $40,000 to $50,000 in annual profit, you need to seriously consider making what's called an S Corp election. This is where the real tax savings happen, and it's criminal how many business owners don't know about this. Here's how it works. You keep your LLC structure for legal purposes, but you elect to be taxed as an S corporation. Now, instead of paying self-employment taxes on all your profit, you only pay it on the salary portion. Let me give you a real example. Say your LLC makes $100,000 in profit. As a regular LLC, you'd paid $15,300 in self-employment tax. But if you make the S Corp election, you might pay yourself a reasonable salary of $40,000 and take the remaining $60,000 as distributions. Now you only pay self-employment tax on that $40,000 salary. That's $6,125 instead of $15,300 in taxes. You just saved over $9,000 in taxes with one election. That's real money that stays in your pocket. The key word here is reasonable salary. The IRS requires that you pay yourself what someone else would earn doing your job. You can't pay yourself $10,000 and take $90,000 in distributions. That'll get you in trouble. But you also don't need to pay yourself $80,000 if the market rate for your work is $45,000. I had a client who was a marketing consultant making $150,000 in taxes a year through her LLC. We made the S Corp election, set her salary at $65,000, and she saved over $13,000 in self-employment taxes in the first year alone. That paid for our services for the next 5 years. But here's the catch. Making the S Corp election comes with additional responsibilities. You have to run actual payroll, file quarterly payroll tax returns, and your business tax return becomes more complex. These additional costs typically run about $2,000 to $3,000 per year. That's why the break-even point is so important. If you're only making $30,000 in profit, the additional cost might outweigh the tax savings. But once you're consistently above $50,000, the math usually works strongly in your favor. Let me share the biggest mistakes I see LLC owners make when paying themselves, because these can cost you thousands. Mistake number 1, not having a separate business bank account. I cannot stress this enough. If you're mixing business and personal funds, you're asking for trouble. Not only does it mess up your bookkeeping, but it can actually pierce your LLC's liability protection. The whole point of having an LLC is to protect your personal assets, and commingling funds destroys that protection. Mistake number 2, not saving enough for taxes. Mistake number 2, not saving enough for taxes. I see this constantly. Business owners who spend every dollar they make and then get crushed by their tax bill. Remember, if you're profitable, you're going to owe quarterly estimated taxes. Missing these can result in penalties and interest that add up fast. Mistake number 3, waiting too long to make the S Corp election. I've seen business owners pay tens of thousands in unnecessary self-employment taxes because they didn't know about this option, or their CPA never brought it up. If you made over $50,000 last year and you're still a regular LLC, you need to have this conversation now. Mistake number 4, not understanding the timing. You can actually make the S Corp election retroactively for the current year, but only until March 15th of the following year. Miss that deadline and you're stuck waiting until the next year to make the change. Here's a story that'll make you cringe. I had a potential client call me in April who had made $200,000 through his LLC the previous year. He'd never heard of the S Corp election and had just paid over $30,000 in self-employment taxes that he could have avoided. We could have saved him $20,000 in taxes, but he missed the deadline by 3 weeks. All right. Let's put this all together into an action plan you can actually use. First, if you don't have a business bank account, stop everything and go set one up today. Get your EIN number if you don't have one. You can apply for free directly on the IRS website. Second, set up that automatic tax savings system I mentioned. Every time money comes into your business, immediately transfer 35% into a separate tax savings account. This isn't optional, it's survival. Third, track everything. Use QuickBooks, FreshBooks, or even a simple spreadsheet, but know where every dollar is going. Good bookkeeping isn't just for tax time. It's how you make smart business decisions. Fourth, if you're making over $40,000 in profit, start researching the S Corp election. Don't just take my word for it. Run the numbers for your specific situation. The savings can be massive, but it does come with additional responsibilities like payroll and more complex tax returns. Fifth, work with a tax professional who actually does tax planning, not just tax preparation. There's a huge difference. A tax preparer files your returns after the year is over. A tax strategist helps you make decisions throughout the year to minimize what you owe. Here's something most people don't realize. The wealthy don't pay less in taxes because they cheat. They pay less because they plan. They make strategic decisions about entity structure, timing, and deductions that most small business owners never even hear about. The tax code is actually written to benefit business owners and investors. There are legitimate strategies to reduce your tax burden, but you have to know about them and implement them correctly. Look, paying yourself from your LLC doesn't have to be complicated, but it does require some basic knowledge and planning. The biggest mistake you can make is doing nothing and hoping it all works out. Remember the key points. Take owner's draws, not salary. Save 30 to 40% for taxes. Consider the S Corp election once you're making good money. Keep your business and personal finances completely separate. And work with someone who knows what they're doing. I've seen too many business owners work their tails off to build successful companies only to hand over massive chunks to the IRS because they didn't understand these basic concepts. Don't let that be you. If this video helped clarify how to pay yourself from your LLC, hit that like button and subscribe for more tax strategies that actually work. Drop a comment below and let me know. Are you currently taking owner's draws or are you thinking about making the S Corp election? I read every comment and often turn them into future video topics. The strategies I've shared today could literally save you thousands of dollars every year, but here's the thing. Knowledge without action is worthless. You need to implement this stuff. If you want to dive deeper into tax strategies that could save you even more, grab my book, Your Biggest Expense, at yourbiggestexpense.com. The link is in the description below. I'll walk you through 10 powerful strategies that most CPAs never mention. Plus, you'll get access to bonus materials that show you exactly how to implement these concepts in your business. Don't wait until next April when you're staring at a massive tax bill wishing you'd planned better. Take action now while you still have time to make a difference for this tax year. Make sure you're subscribed because I'm always sharing strategies like this that can save you thousands in taxes, and you don't want to miss out on what's coming next. Thanks for watching, and remember, keep more of what you earn.